Hello, everyone. Welcome to Retire with Style. I'm here with Wade Fowl, my trusted companion, and I am Alex. And we are going to be all things tax efficiency. I don't know, all things taxes today. Right, Wade?
Right. That is right. And we're going to be talking about something that's an underappreciated member of the crew, the tax location.
Yeah.
Tax allocation tends to get all the coverage, but tax location is an important topic too.
Just like in real estate, location, location, location.
That's right.
Real quick, Wade, last week's episode, you had the same shirt. And you mentioned that you used first in, first out. No, last in, first out method for your shirt drawers or your closet. So I can see that you weren't lying to me. You actually do that. Interesting.
Yeah, definitely. The same. Well, I don't put these shirts in drawers, but with t-shirts, I definitely tend to. I may have 20 white t-shirts, but it's always the same one that I'm wearing all the time.
Really? No one would know. No one would know. So I think that suffices for the small talk. Oh, by the way, you were in that podcast episode with Joe Curry. Did he ask you about pull-ups? I asked him to ask you as well.
Yeah, although I don't know if that one's been released yet, because a lot of podcasts they're more organized and have long backlogs of recordings before.
No.
But yeah, we talked about the pull-ups.
Well, we don't like to record. And what number did you tell him?
That I never got more than 6 at a time, but I'm working on it.
That's good. That's good. Don't forget, I got pickleball wrist, so I can't do anything for a while. I'm on the injured reserve list. I'm on the physically unable to perform list, like in football. So I need 4 weeks off before I get back at it. But today we're talking about asset location and asset allocation, right? And these are one of these things that actually I think are important and flies under the radar, again, in terms of put in the bucket of things you can control. I think asset location is quite important in terms of being able to add, 40 to 60 basis points, if you will, to overall returns if you do it systematically and correctly. And if you try not to, like, sometimes we see statements from prospects, right? And they want us to, hey, what do you as they're coming into McLean. And what gets me all the time is that you have an IRA, a taxable, a tax-deferred, and they all have the same allocation within it. They just kind of mirror each other. And the reality is, that's not the way to do it on many levels. And that's what we're going to talk about today. Why not? And what are some main issues with it? And the first one is it's not really tax efficient from that vantage point. And the reality is you should be looking at your household account, your household aggregate assets, not like each individual account is its own living and breathing thing. Wait?
Yeah, that's true. You even really want to think about your human capital. Like if your work income is more bond related.
Oh, yeah.
You might want to consider that as part of your bonds. So.
Yeah, and what he means by that is if you have a job that's like a government position where you almost have to try to get fired, you're probably going to be working there for the rest of your life, assuming that it fits what you wanted to do, and you're going to have a pension. And so that's a pretty steady form of income. And that's what Wade means. That's like a bond, if you will. Mm-hmm. Whereas if you're an entrepreneurial guy, let's say you're 100% salesperson and 20% of your salary is base and 80% is commission, it's a lot more variable. That's more stock-like, if you will. That's kind of what you're getting at with that. And truly speaking, the rational, quote unquote, economists from the planet Vulcan would consider that as part of their allocation, their human capital piece.
Yeah, thanks for being the Wade whisperer. But that was a reference to our U.S. stock or a bond. Moshe Milevsky, he's the planet Vulcan.
I got it, Wade. Thank you very much.
Yeah.
Thank you. Thank you for
citing two different aspects.
What I told you.
His prodigious output.
Yes. All right. Let's nothing to it but to do it. I guess that's my go-to phrase for today. Fire away. What do we got here?
Well, we do have to put a caveat at the beginning that
Okay.
asset allocation is always most important. You don't let the asset location dog wag the tail of asset allocation. You choose your asset allocation, but then to the extent that you can, you'll follow these asset location principles. But you don't, it's like, well, if I hear that bonds should be in my tax deferred account and I don't have enough space for all my bonds in my tax deferred account, that means I can't hold bonds outside of it. That's not what we're saying. We're saying first choose an asset allocation that's right for your risk tolerance and risk composure and all that sort of thing. And then to the extent that you can, start positioning the stocks and the bonds and the different assets in the different types of tax treated accounts in the most efficient manner that you can.
Okay. No, that makes a lot of sense. Hey, you said something that really caught me by surprise and merits a further unpacking. You said dog, like dog or something, as opposed to dog.
Dog.
Was that you trying to inject some personality in that?
No.
Okay,
Dog's weird.
No. I thought you were messing around. I thought you said the dog wagging the tail, something like that. I thought you.
I may have extended the syllable because I was trying to figure out if I was getting the analogy correct or backwards.
I
thought you were the dog wags the tail or the tail wags the dog.
Yeah, I got you. I thought you were messing around for a second, so I thought I got to point this out. That's not, hey, you're all business, and all of a sudden,
my syllable as I thought about it.
I thought you were flexing that comedic muscle, which I lack, by the way, apparently, but that's fine.
The reviews are pretty consistent.
Yeah, pretty consistent.
Except for the one from your sons.
Yes. All right. So tax efficiency spectrum between, no, you made the distinction between tax allocation and tax location. Yes. Asset allocation is the go-to, but there's a lot of value to be had when you layer in tax location to it.
Mm-hmm.
How
and
so?
So the idea is we want to think about the tax efficiency of each asset you're looking at. And then to the extent that you can, assets that are more tax efficient should go in the taxable account where it's not such a big deal to have to pay those taxes. Assets that are less tax efficient, you want to tend to put in tax advantaged accounts, which could, and then we'll talk about tax deferred versus tax exempt. But by tax efficiency, we just mean how much are they kicking off taxable income on an ongoing basis versus how much are they naturally providing tax deferral and so forth. And so let's just talk about different assets going from most tax efficient to least tax efficient. And The first one, we should just mention tax-exempt bonds. We're not going to go into a deep discussion about municipal bonds or anything, but it's an obvious example of there's no purpose in holding those in a tax-advantaged account. The only place they have any possible role is in a taxable account. They tend to offer lower yields because you're not going to have to pay taxes on interest payments. And so when you think about their pre-tax yield, if you're in a higher tax bracket, and usually you have to be in one of the higher tax brackets before this makes sense, but you may get like a better pre-tax yield when you're not having to pay taxes on that interest. So that's just the obvious one. The only place you'd even think about putting those is in a taxable account. Now, there's some issues with tax-exempt bonds, especially the rules that determine how Social Security gets taxed, that determine Medicare premiums, both require you to add that tax-exempt interest. So it may indirectly trigger some taxes. But at least the idea is you're not having to pay taxes on the interest from tax-exempt bonds.
Okay. What would be next on that hit list?
Yeah, so then we're really talking about like U.S. stock index funds. They tend to be pretty tax efficient, especially if the dividend, and the reason I'm saying U.S. versus international is just right now, the dividend yield tends to be less on U.S. versus international. So less ongoing dividends. Index funds are, the reason we're saying index funds is because they're more tax efficient since they're not doing the internal trading. Actively managed funds, they may be buying and selling inside the fund that will lead you to get tax bills every year on those transactions. Index funds tend to not do a lot of trading like that. And so it really a lot of the benefit will be through when you eventually sell, the long-term capital gains that get the better tax treatment. And you're otherwise getting tax deferral on those gains until you realize them. You are paying taxes on the ongoing dividends. Hopefully a lot of that will be qualified dividends. But just as we're listing from most tax efficient to least tax efficient, US stock index funds are right up there on the high tax efficiency list.
Okay.
So again, a natural place to put those would then be your taxable brokerage accounts.
So we're saying index funds, but what we're kind of getting at here is passive versus active. But I'll even go one more nuance. It's just index funds tend to have much lower turnover than like actively managed funds. But really, it's the turnover that's causing the tax within that. And so I guess you could conceivably have an active fund that holds 10 stocks and never trades it for 20 years. I don't know.
Yeah.
I'm not up to date on it. Maybe Dodge and Cox or something like that. But the reality is there could be a fund that's active and just they never trade the stocks. Sure, you may not have taxable like capital gains kind of thing from turnover, but you may have crappy performance. So, stick with the index fund is my thing. But I just wanted to make sure it's not necessarily it's the attrition within the index fund is usually much lower than active funds. No.
Yeah, and if an active fund is not trading, they may be stretching the definition of active. But
that's true too.
Yeah, it's just they're not. You may not buy or sell shares, but the shares that you own internally, the fund managers are buying and selling, and so they could be generating taxable income, and then that's reported to you. So even though you didn't sell your shares, you're going to have to pay taxes on gains from those shares on an ongoing annual basis. And that just happens less. There's less turnover, less trading with index funds.
Okay. And then the corollary is international, but the differentiation is just a higher yield, so it's a little less tax efficient.
Yeah. International stock index funds, just same story as US, but
they just happen to have a higher yield right now.
Higher yield, that's more ongoing taxable income. Okay. And then there can be some annoying little quirks about they may be paying some foreign taxes, and then you have to deal with that. But otherwise, pretty tax efficient.
Okay.
Then we say cash, and well, if it's cash that's not earning any interest, then we're not. That's not what we mean. But cash tends to have lower yields, but it's all taxable interest, so it's going to be less tax efficient in that regard. All the return on cash, to the extent that you're getting some yield on it, will be taxed as ordinary income on an ongoing basis. It's just they're more tax efficient than other fixed income options because they tend to yield less than other fixed income options.
All right. Then we have actively managed stock funds, which is, it's a function of their turnover. Think about it. If an active manager is telling you I can pick the best stocks, then the implicit thing is I'm going to always be looking for the best opportunities, selling the ones that aren't hitting, et cetera, et cetera. So you're naturally going to have a lot of turnover, and that just effectively causes a significant drag on the portfolio.
Yeah, and we didn't mention explicitly between short-term capital gains and long-term capital gains. If there's short-term gains, that's where that trading's happening. They owned an asset for less than a year before trading it. Short-term gains are taxed as ordinary income. Long-term gains on assets held for longer than a year are what gets the preferential income treatment. So actively managed funds, not only with the turnover generating more gains that you have to pay taxes on, but the possibility that more of those gains may also be short-term gains that are taxed as ordinary income. But also a portion of that long-term. That's the reason this is still ranking higher than what's coming on our list is they're still going to be giving you some, hopefully, if they do
losses,
a decent job, long-term capital gains as well.
Yeah. Okay. Bond funds is next. Government bond funds.
Let's say government bond funds. The issue there is really just the interest is taxable on an ongoing basis. So that's less tax efficient. Bond funds can have gains or losses as you sell shares and are not holding them to maturity. Those could be taxed as long-term gains or losses if you've held for more than a year. But otherwise, a lot of that income is ordinary income. generated on an ongoing basis through interest payments.
Okay. Corporate bond funds?
Yeah, the idea there is really, well, treasury bonds, you don't have to pay state income tax, right? And then corporate bonds, to the extent they have higher yields, and also you have to pay state income tax. They're just kind of below treasury bonds on the list. So
And
we're
then
getting to
you
less
have
and less
here,
tax efficient.
you have here one I didn't think, cryptocurrencies.
That is not on my list.
I'm just keeping you honest, Wade. I didn't know if you were paying attention.
But I don't know. I'm guessing they're not all that tax efficient, but that's not an area I've really.
I don't know. I don't know if they're debating if it's a stock or a commodity or something like that yet, right? 100%. I'm not up to speed on it.
But commodities is next on the list, and they do tend to be tax inefficient. Just a lot of issues.
And then we round it off with REITs, real estate investment trust. Why is that one on the bottom of the barrel in terms of tax efficiency?
Just a lot of the quirks of real estate. If you own REITs, you may face complicated tax issues and taxes on an ongoing basis through the distributions.
And REITs, a lot of the returns from REITs come from the dividends as well. I mean, if you look at the amount of dividends they kick off, it's quite high. And so, it's kind of like why international stocks are below U.S. stock index funds, because, they have a higher yield. REITs, much of their returns, comes from just the yield they provide. Now, wait, philosophically, okay, I see why this should be in the, these are the, REITs are least tax efficient, so they should be in tax advantage accounts, right?
To the extent possible.
Yeah, to the extent possible. U.S. index funds are the most tax efficient, absent bonds. I'm not going to consider tax-exempt tips and stuff like that. I'm not going to think about right now. So U.S. stock index funds should be in taxable accounts. But then somebody says, and I'm sure our listeners could be thinking, all right, so you're telling me to put the stock index funds in a taxable account, and then by default, you're telling me to put corporate bond funds, to the extent possible, in tax advantage accounts. Right? But Wade, intuitively, I have trouble reconciling this. Over the long term, stocks will outperform corporate bond funds. So shouldn't I have the index funds of stocks in a tax advantaged account, because it's going to grow tax deferred for many years, and then when I take it out, that pot of money will be so much higher than if I had put corporate bonds in there?
Well, yeah, it's a good point. Like you want to expand and grow your tax advantaged accounts, but at the same time, with tax efficient like U.S. stock index funds, you're getting a lot of tax deferral because all the gains are deferred until you sell. And then you get the long-term capital gains treatment versus the ordinary income treatment. So if you have very tax efficient U.S. stock index funds, every year, yes, you're going to have some dividends to deal with, but a lot of the returns and the dividend yields are low from a historical perspective. So a lot of the return ends up being long-term capital gains, and that is tax deferred. So it's not that you're uniquely losing out on tax deferral by having them in a taxable account. That's why they're tax efficient. They efficiently provide a lot of their return as long-term capital gains that you're not taxed on until you realize through selling those shares.
Yeah, so
plus, if you're really ahead of the game, you've got that step up in basis consideration, which you don't get with tax deferred accounts. We didn't explicitly say that before, but yeah, you don't get. You have now with Secure Act 2.0 or 1.0 the 10-year window for adult beneficiaries to deplete those inherited IRAs.
So then I just want folks realizing. So then the mental math that you're doing is, and I'm going to make up numbers here just to make it easier on the example, but let's say stocks are returning 10% a year. That doesn't happen, but just saying that stocks return 10% a year. But because an index fund is so efficient, you're not losing that much on a tax drag on a year-to-year basis. Let's say, again, making this up, let's say you keep 9.75% of the 10% return, right? Whereas a REIT fund, let's say over the same time period, it returns 8% a year. But instead of just losing out on a quarter of a point because of tax drag, you only keep half of that. So you only keep 4 to 5% of that return. right? And so as opposed to keeping only 4 or 5% of that 8% return in a taxable account, you stick it in a tax deferred account and you gain percentage points back.
Mm-hmm.
That's the thinking when Wade said you get to keep 100% of your return, 90% of your return, 95%, whatever that number is. Wade,
Yeah.
did I miss something there? Because I was doing that on the fly.
Well, just the dividend yield on
Yeah.
U.S. stock index funds is maybe like 1.5 to 2% in that ballpark. But yeah, if you're getting 10% a year, the other, in that case, 8 to 8.5% would effectively be deferred as long-term gains until you finally sell those shares. And you may never have to pay, or your beneficiaries may never have to pay on that with the step up in basis if you hold that asset through death.
Okay, just wanted to point out what's happening there from a dynamic standpoint.
Mm-hmm. Yeah, well, then the next issue I changed to this term tax advantaged, but there's the two tax advantaged accounts, the tax deferred and the tax exempt. So we should also talk about how to think about where to position less tax efficient asset classes between the tax exempt Roth accounts and the tax deferred IRA 401k type accounts. And the big punchline to that is assets so less tax efficient, but that you expect to have higher returns over the long run. That's a good option for the tax exempt accounts. And then assets that are less tax efficient and have lower expected returns over time, those are good for the tax deferred account. And so what I'm really saying here is like bonds would be less tax efficient, lower expected returns over time. That's tax deferred. Your emerging market funds, your small cap value, the different things that are not all that, your actively traded type funds in that area, not tax efficient. But also you're expecting a higher return on that over the long term. That would play a better role in the Roth account. So to kind of simplify that discussion so far, it's like US stock index funds in your taxable account, bonds in your tax deferred account, the kind of more wild stock type funds that you may have in your Roth account.
Now, how do you think about this in light of now the practical, and it could be later for later discussion, but as you're taking distributions, you deplete certain accounts before the others. And in doing so, because you don't have an equally distributed allocation across every single account.
And yeah, that's a key punchline is you don't have the same allocation in each account.
Philosophically, how do you think about that?
So when we start thinking about withdrawal ordering in retirement, that concept works pretty well with the Roth because we're saying you're putting in these like more risky, really, asset classes with higher expected returns. That's because they're more volatile. So those are funds you tend to want to hold over longer periods. And on average, your Roth accounts are what you'll be holding on to the longest on average with a tax efficient distribution strategy. So it works quite well with that. The less tax efficient, higher yielding, higher returning assets go in the Roth, and they have the longest window to benefit from that concept of stocks for the long run. So that part's okay.
Okay.
The other advantage there too is if I had the stocks in my tax deferred account, all the gains, all those long-term capital gains would be taxed as ordinary income instead of preferential income. And you avoid that by having them in the Roth account because the gains are not taxed at all. So you're getting all that growth tax-free. Okay,
now I would say this is me being devil's advocate. But Wade, you said asset allocation was the dog and the asset location was the tail. But now I'm 75 or whatever, and I just have a Roth IRA, and in that I only have emerging markets. So I'm a 75-year-old with $2 million in emerging market fund, and that's it.
Mm-hmm. Well, you may need to make some adjustments over time because asset allocation always comes first. And then the other point too is, as we get into the retirement distributions, it's generally, now with exceptions, and we'll dig a lot into that, but you tend to spend taxable accounts first, then tax deferred, then tax exempt. So yeah, you're creating this problem of spending down my US stock index funds first, then my bonds, then my emerging market funds or something like that.
But then and then the extension is, hey, these are tax deferred and tax exempt accounts. You can sell whatever you have in there, and buy whatever you need to diversify, and it's not a taxable event.
Right, and rebalance.
That's the other. You can always just do that, right? There's nothing stopping you from, okay, you're 75, and your RMDs is just destroyed your, not destroyed, but depleted your tax deferred account, and now all you have left is the Roth. Well, there's nothing stopping you from just selling funds, selling all of your emerging markets to diversify.
Mm-hmm. Right. And then there's also the point that money that you're going to spend soon, you're not supposed to have in the stock market. You want to have that in bonds. So that, like, in practical terms, another overlay may be you want some cash in your taxable accounts as well to manage spending from, so that you're not being forced to sell all your US stock index funds to meet expense needs when you're otherwise following the idea that you should be spending from your taxable accounts first. And also, just having the less growth in your tax deferred account just is a nice consideration from the perspective of they're the least tax efficient in terms of having all those embedded income taxes for your beneficiaries as well. You're not leaving your beneficiaries embedded income taxes with a taxable account due to the step up in basis or with the Roth account. You are leaving them with an embedded income tax with the IRA assets. So to the extent that your asset allocation calls for holding bonds, putting those in the account with the least the least advantages for your beneficiaries can make sense from the perspective of just having less growth in those accounts. If you're of the belief that stocks will over time grow faster than bonds, of course.
Okay. So then to tie a bow on this, the headline is taxable accounts, you put in the most tax efficient assets. Tax deferred, which are regular IRAs, things like that. Tax inefficient assets with lower expected returns. Tax free, the Roths of the world. Tax inefficient assets, but the high returns, the higher expected returns.
Mm-hmm.
And I think we're golden.
Bingo.
Yeah. All right.
Now,
let's go to the next
There
one.
is another topic while we're on the issue of asset location. And I mentioned in the last episode, if you're a diligent saver, you may not have enough, you may fill up your available capacity in your tax deferred and Roth accounts. So you're forced to also save in a taxable account, even if you didn't really want to. But we can talk about some of the other options available that may create some tax efficiency for you in your taxable account as well.
Fair enough.
Okay. Yeah, so to get into that, there's 3 tax advantages you can receive in the tax code, and different accounts have different combinations of these. So one tax advantage, you get a tax deduction on the contribution. That reduces your adjusted gross income. It's an above-the-line deduction. Lower adjusted gross income. If you're in a high tax bracket, less taxes. A second possible advantage is gains can accumulate on a tax-deferred basis until distributions or sales are realized. And the third one is gains can be distributed on a tax-free basis. So this is different because different accounts have different combinations of these. So to kind of use those principles, a brokerage account, you don't get the tax deduction. You're putting in after-tax money. You don't get tax deferral like an IRA would provide. We did talk about you're getting some implicit tax deferral on long-term capital gains, but we're not going to fully say tax deferral on brokerage accounts. And you don't get tax-free distributions either. All gains are going to be taxed. IRAs, 401ks, what we call tax-deferred accounts, yes on the tax deduction, yes on the tax deferral. No on tax-free distributions. It all comes out as ordinary income. The Roth, no on the tax deduction, yes on the tax deferral, yes on the tax-free distributions. Okay. So then we can talk about some other things. So 529 plans for college. What features do they have? Well, with tax deduction, there's no federal tax deduction, but some states will provide a tax deduction on the state income tax, at least, for contributions to the 529 plan. Then you do get tax deferral. And then if you're taking for qualified education expenses, you do get tax-free distributions. So they have similar properties to Roth accounts in that regard, as long as you're taking the distributions for qualified education expenses. Then we have the health savings accounts, which is your favorite. So you want to mention their advantages?
It's the trifecta, effectively. You know how when Wade was going through these, he was saying yes, yes, no, yes, that kind of thing. The health savings account is yes, yes, yes.
Yes, yes, yes.
That's my
for qualified medical expenses.
Yeah. For medical expenses. Does that, and if you keep receipts, before you qualify, you can apply them when you do qualify.
No, it's because the point of that is, if you just want to let the account grow to benefit from the tax deferral and tax-free distributions, you don't want to take that money out today to compensate you for the medical expense, but you save the receipt.
In my head, the way I meant it is, I'm not planning on touching. Yes, I could touch it now, but I'm not planning on touching it until I'm like 65, 70. It's kind of like my quasi health insurance booster, if you will, right? So I can apply it or not, but yeah, I don't want to touch it because it's tax-free, tax-deferred, right? And so for me, let's just say my wife and I say, yeah, when we're 65, we can start tapping into it, or when we're 75, whatever date we want, right? And then the reality is, if you keep receipts now, even though I physically don't want to, apply until I'm 65 to these things, I can use receipts from when I was 55 years old.
Or when you're 40 years old.
Yeah, when I'm 40. Yeah. When I'm 40 years old. That's where I was using in my head this sort of demarcation on age, but that's a self-imposed one to allow growth.
That tax-free growth and tax-free distributions on the growth.
Yeah, so it's yes, 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 across the board. I-bonds, E-bonds, next one.
Yeah, that's something you'd buy in your taxable brokerage account. Specifically, you need an account at Treasury Direct, but no on the tax deduction, but yes on the tax deferral. So that's great. Compared to taxable bonds, you get tax deferral on I-bonds and E-bonds, no on the tax-free distributions. When you sell those, all the interest will then be realized as gains for that year.
And you mentioned it earlier, the tax-exempt bonds, which are usually muni bonds. What was that about? You said you were talking about interest, they're applied on your Social Security, et cetera, et cetera.
Yeah. So no tax deduction, yes on the tax deferral, yes on the tax-free distributions. But however, that interest in the calculations, those modified adjusted gross income measures that we'll be talking about in later episodes, those measures on how Social Security is taxed and how Medicare premium surcharges are determined will include tax-exempt interest as part of your income. So you can be indirectly taxed by having to pay taxes on more of your Social Security or having to pay higher Medicare premiums.
Okay. And then what would you say for these other two? There's two more on our list. You hear it all the time. Never put an annuity in a tax-deferred account, this or that. But I'm exaggerating here. What you want to just talk about annuities, non-qualified annuities?
Yeah, so non-qualified annuities, that's the annuities you hold in a taxable brokerage account. You didn't buy it inside of a qualified plan. They provide tax deferral. So that's the point about not having them in a qualified plan. You get tax deferral there anyway, so you don't need the annuity to have the tax deferral.
This is the living benefits. I'm just talking.
Yeah, you do it if the purpose is for income, and then can be. I mean, you may want the income, so you may want the annuity in the qualified plan. The only point is you're not uniquely getting tax deferral by having it in a qualified plan. But if you do buy it outside of your retirement plans, and this is where we're talking about, if you don't have enough space and you want more tax benefits, you might consider a non-qualified annuity for tax deferral. No on the tax deduction, yes on the tax deferral, no on the tax-free distributions, qualified annuities.
And then because we leave no stone unturned, what about cash value of a life insurance policy?
Yeah, so when you start listening to life insurance sales pitches, they'll kind of describe it as almost like a Roth account and talk about how taxes are going to go up in the future. And so the end of the pitch there is with the cash value of life insurance would be no on the tax deduction, yes on the tax deferral, and then yes on the tax-free distributions, but with an asterisk, subject to the policy is properly structured and you're not avoiding or not violating any of the rules that you're allowed to take proceeds from a loan or return of principal and being able to generate spending power without generating taxable income. So tax-free distributions when structured properly. So we're getting no, yes, yes, and that's the same characteristics of a Roth account. And so that's why they're sometimes pitched as Roths with no earnings contribution limits. You can just fill up life insurance as much as you want. And in many cases, it's pitched with that sort of tax advantage in mind.
All right. Well, wait, I think this gets us to the table set, from the vantage point of the next episode, in which we'll talk about just withdrawals and, how to do that from tax advantage plans, et cetera, et cetera. Wouldn't you say, or is there something that we could be missing here in table setting?
No, I guess we could mention like with the health savings accounts, if you take a distribution for a non-qualified medical expense, there is a 20% penalty. So keep that in mind. But otherwise, and you do have to be enrolled in a eligible, high deductible health plan to make those work. Otherwise, just seeing if there's any other interesting notes to point out. Looks like we're pretty good. We've got the asset location under control, and in later episodes, we're ready to start really digging into that withdrawal phase of life.
So we're going to break our rule of why go 45 minutes when you can go 37 minutes?
That's right.
All right.
Get a few minutes back today.
All right, everyone. Well, thank you for listening in. Now that we've set the stage, we will talk about withdrawals, from a retirement income standpoint, taking all of this into consideration. All righty, Wade?
Okay. Thanks, everyone. Catch you next time.
Bye.